Hey, I'm Kate Stalter, and today we are going to look at something that often gets forgotten because, frankly, it's just not as exciting as fast-moving trades. However, it is critically important for retirement success. And what am I talking about? It's asset allocation, and just means how you divide your assets, your investments, according to different asset classes. We'll take a look at that. We'll see a few different examples today, so you'll see how that can work. Now, the goal of asset allocation is pretty simple. It's just to balance risk and reward by spreading your investments across different categories. Very simple: stocks, bonds, and cash. Now, stock ETF, here's one you're very familiar with, the basic S&P 500 SPY ETF. It offers growth potential, but also higher risk. Yeah, the S&P 500 does carry risk. I'm sure most of you know that. Bonds, like the AG ETF that you see right here, an index of investment grade bonds, provide stability, but with lower returns. Now, of course, asset allocation is more diversified than just two ETFs. That was a very simple example. By spreading your investments across a lot of different assets, stocks, from different countries, different market capitalizations, different sectors, bonds try to tilt towards short-term, high-quality bonds, but there's also a role for more intermediate and longer-term bonds, government bonds, munis, depending on one's portfolio. Real estate is another asset class, cash equivalents. By having all of these, or at least some mix of these, according to what your financial plan dictates, that is a way of minimizing the risk of one underperforming sector dragging down your entire portfolio. Now, we're looking here at the Vanguard Total Stock Market ETF, VTI. This is a weekly chart. You can see some of that volatility on there. And let's take a look here at BND. This is also a Vanguard ETF, tracks a broad index of bonds, has a beta of 0.12, meaning it's far less volatile than an equity index. And here's a look at the real estate ETF, VNQ, quite cyclical in nature, and you can see how it's very interest rate sensitive. You had a nice run up here after it became clear over the summer that looked like interest rates would be cut. Now, in this flow chart, just to give you an idea, you've got three different types of investors: a retiree, mid-career, and younger. So when you're deciding on your asset allocation, consider the factors like your age, risk tolerance, and financial goals. For example, a younger investor would allocate more to stocks. Mid-career, you're kind of having more of a balance between stocks and bonds. And then by the time you're retired, you do need some stocks. You need that growth, but you're also wanting to preserve capital and mitigate some of the volatility of stocks. That becomes very important as you're already in retirement and you don't want to put that money at risk as much as maybe you could have when you were 25. Now, there are three common asset allocation strategies: aggressive, moderate, conservative, and aggressive strategy, like those that focus on stocks and growth funds like the QQQ. Those aim for high returns, but investors also have to expect higher level of risk. A moderate strategy, like the mutual fund VBINX, balance stocks and bonds for a mix of growth and stability. You kind of have built-in diversification in this one. And then conservative strategies, like another mutual fund VBTLX. That one prioritizes capital preservation by focusing mostly on bonds, and you have a look at the 10-year performance comparison of these, and you can understand how the risk and return factors are related here. Oh, and by the way, higher return isn't necessarily better because you want to allocate your portfolio to generate what you need in retirement. So those mutual funds with a lower return, lower risk, what are they doing? They're helping to mitigate some of the volatility in an equity index. They all work together. As markets fluctuate, your portfolio can drift from its original allocation, and rebalancing on some kind of regular basis can help you ensure that your portfolio stays aligned with your goals. For instance, if your equities, say in the form of the S&P ETF, outperform, you may need to sell some stocks and then buy bonds to restore your original target allocation. Now, asset allocation, I know, it is not one of those amazing, fun trades with eye-popping returns, but your future self will thank you for being just a little bit boring with your long-term investments if you allocate according to your goals, time horizon, and risk tolerance. With a well-thought-out asset allocation strategy, you can be confident that your portfolio is designed to meet your financial goals without blowing up, okay? Thank you so much for watching today.